Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking apartments, the multifamily market. Now we have an expert panel. Please welcome my guest. It's Stephen DeFrancis. Stephen is the founder and CEO of Cortland Partners. Stephen, thanks for being with us in Studio One.
Thanks, great to be here.
Also, please welcome Benno Rothschild. He's a partner with the law firm of Hartman and Simons. Benno, thanks for being with us.
Thank you. Glad to be here.
Also, please welcome Jamie Tebow. Jamie is president of the Atlanta Apartment Association. Jamie, thanks for being here.
Thank you. Happy to be here.
Well, guys, we just heard about the market, and it's still doing really well. But I'm curious what you guys see. I mean, you know, as a lawyer dealing with all your clients, and as an investor and developer, and then also all the folks that are at the Apartment Association. I mean, it's got to be different views here. So Benno, what do you see? What are your clients telling you about how they see the apartment market today? Are they any concern about overbuilding or?
Oh, certainly. Yeah, I mean, there's definitely some concern about that. But I think, you know, as attorneys, we're sort of leading edge on those kinds of things because people get under contract before they actually close, and so, you know, we're 3-6 months out. You're kind of seeing what's going to happen because you're working on it before those transactions occur. But we haven't really seen any slowdown in those transactional volume. I mean, there's definitely lots of things going on, and people, you know, seem to be coming back, and there's a lot of appetite for multifamily right now.
Yeah. And Stephen, what do you see with your properties? Is everything just hot as it can be?
Things are still going really well in all of our markets. Houston slowed down a little bit, but the rest of the markets we're in are continuing to see really strong growth. We tend to be, we focus principally on value add investing. And so we tend to be right below the top tier of the product mix. And as you can imagine, all the new development tends to be in the very highest end products and locations. So we're still seeing a lot of growth, which some of it's just from the organic growth in the market, some of it's coming from folks who are moving down as rents continue to escalate ever higher.
So in your value add properties, are you seeing greater rent increases in the last year than the 4.1 because of that market you're in, or?
We are seeing consistent rate growth year over year that we have seen over the last 3 or 4 years. Mm-hmm. You know, where we are seeing a little change in the market now, maybe a little, there's more competition on the buy side, you know, so you're having to pay a little more for these opportunities, but there continues to be, you know, a number of opportunities in the value add space to find properties that are, you know, where the physical plant, the offering is suboptimal for the location.
Yeah. And Jamie, what are your members telling you? Are they concerned about the market? Or are they still as happy as they can be doing the Snoopy dance?
Well, the market is still in a good place. Yeah. It's not as hot as it's been, particularly on the urban infill side, but the suburban areas are still pretty strong. We'll continue to see supply coming online through 17, mostly in the infill locations. So that puts a little bit of a damper on the rent growth. But to Stephen's point, the value add options are still plentiful out there in the market. Lots of properties going on the market that gives somebody an opportunity to get that rent growth with some capital investment.
And what do you guys think moving forward? I mean, do you think we're still going to have this kind of growth moving forward for the next few years? What's your crystal ball say?
Well, I'd tell you one of the things that at least some of my clients would be worried about is, I mean, if you look at this core plus stuff and it's going so well and there's so much growth and there's a lot of new product going in and people are, you know, talking about how much is coming on the market. Well, if those people start discounting and giving that free rent, you know, up front, you know, the month, the 2, you know, to get people in because that market softens because there's so much coming online, I mean, that's got to impact your stuff too. I mean, that, you know, that's going to impact those B guys because they're like, well, you know, if I can go to an A class, you know, in that core market and I can get a month free rent or I can get, you know, a month and a half free rent, then, you know, maybe it's not as attractive to be in a B class property.
But if you're still buying, Stephen, you're bullish on the apartment market.
We remain bullish. You know, we feel like you still have another, you know, 7 or 8 years of pretty clear growth on the demand side. You know, you are going to have soft pockets, soft submarkets that are being hit as a result of overbuilding and oversupply. Mm-hmm. At some point in that time period, we're likely to have a downturn in the economy, which will cause some, a softness in the market on a more macro basis. But there's a pretty clear, continued growth on the demand side. The good thing about supply is it doesn't sneak up on you. It takes 2 or 3, 4 years to come out of the ground. So you should be able to navigate through that if you're actively managing the portfolio. One of the good things that we see is because of the huge increase in construction costs over the last 5 years, that has pushed all of the development community to develop only at the very top end of the product mix. So as a result, the spread between new development and sort of A- properties is as wide as it's ever been. So there's a lot of room, if new development introduces concessions, for them to concess their rents before you start to compete with the A- and then of course the B and on down the line.
Yeah.
So, one of the great things is we're seeing finally seeing some slowdown in starts with the pullback in the lending community with financing of new development, which we hopefully will continue. And if we can continue to see that trend. As you go out into 18 and 19, we should be in great shape because, the demand side seems very, to be growing at a pretty clear pace.
Yeah, and Benno, you've seen your client really be interested in buying existing product, partly because of these construction costs, right?
Absolutely. I mean, when they're telling me that, well, if I buy something now and versus new construction, I mean that differential is crazy big. I mean, as you're saying, it just really is. And I wonder how you're going to find, more core plus A properties where people are willing to pay those construction costs, and that has got to dampen that over the next couple of years. I mean, you just see it. It has to happen. But the weird thing is you haven't really seen it yet, which is surprising me.
Yeah.
And just to add to Stephen's point on the supply picture, it's really being stretched out. There's a labor shortage. So even though it looks like a lot of supply is hitting at any one time in any particular market, it's taking a lot longer to bring the product to market than it used to. Yeah. So that and the lending crunch is really helping spread out that supply picture.
And you mentioned lending. So Stephen, how are you seeing lending on existing product? Are lenders starting to get a little more cautious?
There's still plenty of liquidity in the debt market for existing product, from what we're seeing. We will, as it relates specifically to us, we are not seeing any challenges in the debt market. What you're seeing is a lot of the more traditional banks who were principally doing construction lending for the multifamily space, now that they're pulling back on construction lending, are moving into more value-add lending. Because the risk profile is different, and as they're being forced by the regulator to pull back on development lending, they're moving into some of that liquidity is moving into the existing space.
I see, and and that's healthy, right? That is kind of keeping a lid on new supply, and we're kind of fixing our own problem. It seems like in the last recessions that we've had, we've really just overbuilt. Right, it's just more product, and we create our own problems. Maybe this time we won't have as, if we do have a downturn, it won't be as bad, right? Well, stay tuned. We're going to take a short break. When we get back, we're going to talk more about apartments and multifamily and what to expect moving forward. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.